Good morning and welcome to The Open here on BNN Bloomberg. I'm Roger Peterson. Thank you for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Oil prices surging again today. Look at that, almost 13% after U.S. President Trump said strikes in Iran will continue. In a primetime address delivered last night, Trump said U.S. forces have significantly weakened Iran, calling the military campaign unstoppable. However, Trump added operations will continue until objectives are fully achieved. The U.S. president also threatened to strike Iran's electric generating plants if a deal isn't reached. Canada's trade deficit widened sharply in February, missing expectations. Stats Canada says the trade gap grew to $5.7 billion, the largest since August. The move came as imports jumped to a record high, driven largely by a surge in gold purchases from the United States. Imports of metal and mineral products climbed more than 45%. Finance Minister François-Philippe Champagne has been joined by Bank of Canada Governor Tiff Macklem and Bay Street executives in China. The Canadian delegation is meeting with Chinese officials to build on the diplomatic reset that occurred earlier this year. The group includes the chief executives of Manulife and Sun Life and the vice chair of BMO Wealth. The talks are expected to include opportunities in financial services and healthcare. And a quick look at the markets. You can see them reacting to what Donald Trump had to say last night. The U.S. president saying the war will likely continue. And the Dow's not liking it. Neither's the NASDAQ, neither's the S&P 500. All of them off by more than a point in futures right now. 1.34 for the Dow, nearly 2% for the NASDAQ, 1.5% for the S&P 500. The TSX, taking a quick look at that. It enjoyed that rally as it pushed towards 33,000, but a pretty safe bet. We may see it go into the red today and drop down again. And oil, of course, surging on that speech last night. It is up more than 12%. Trump telling countries to go get the oil themselves or buy it from the U.S., reiterating that one again. Okay, the markets are trending lower after that speech. It offered little hope of a quick end of the war. Add to the fact oil prices jumped to 12% right now. Government bonds being sold off in the U.S., pushing up yields. Let's get some perspective. Joining me now is Christine Tan, Portfolio Manager at SLGI Asset Management. Christine, thanks as always for joining us.
Good morning, Roger. Thank you for having me.
Did you have a chance to see the speech or listen to any of it?
I did. I did. I had it on, basically I had multiple computers on around the house in case I missed it.
What part is right? I mean, is there any one thing from that speech, or is it the entire thing that's kind of rocking the markets right now and oil?
I think it's about the expectations from the market and investors, and even our expectations heading in. It is pretty unusual, not necessarily rare, especially for President Trump, but it is unusual to call for an address to the state, right? So I think the thought was that we might get a little bit more, hopefully, a sense of what the off-ramp could look like, some sort of clarity on what potential objectives are. I think, he stayed pretty true to script. I think it was a very short speech, actually, and it was repeating and kind of reiterating a lot of what we've heard before. Perhaps the only net new, if you will, was the mention that if there isn't some sort of agreement or a ceasefire soon, that there could be a possible hit on energy facilities. That was kind of a little bit of a net new. So I think, coming into the speech yesterday, we did see markets rally, again, pricing in that optimism that perhaps we get a bit more clarity on a potential off-ramp. But in terms of new information, there wasn't too much. So perhaps today's action is a little bit more about reversing some of that optimism as opposed to true pessimism.
Right now, I'll take that as some optimism with everything the way it's unfolding. So do you think this will be what we'll see on the markets? I mean, a down day it looks like, but not as down as it could be if they really thought this thing may last a long time?
Correct. And that's exactly the right way to sort of characterize it, Roger. It's the market still they are sort of taking a little bit of comfort in that 2 to 3 week timeline. There is a little bit of concern in terms of the talk that perhaps we might see a little bit of an escalation over the next 2 to 3 weeks. But again, the hope really is that this conflict will resolve within weeks, and the Strait of Hormuz will start to normalize. And the ultimate thing that we're all watching for is to make sure that there are no oil facilities that are actually permanently disrupted. Because there are two sort of phases to this. The reopening of the Strait of Hormuz is obviously the most important phase right now because there are a lot of goods that move through it, fertilizer, helium, in addition to oil. But the second and more longer-term impact is what kind of permanent or longer-term impairment to production if facilities are actually impacted. So that's kind of what the market's trying to assess, and that's what we're trying to assess as well. It is details are quite scarce, rightly so, given that it is a live conflict.
And with oil, it's up 12, nearly, I think 13% today. What are your thoughts on that? Is that just a reaction and it'll calm down, or is this the start of something we could see it continue to climb? And that 150 some people have been talking about may be on the horizon.
Yeah, it's hard to tell. I mean, when it comes to oil, I've been in the industry since the 90s. It's very hard to predict the direction of oil because a big part of what we're seeing, especially since it's the front end of the curve, is the pricing in of uncertainty, right? If you look at the back end, oil prices have been remarkably stable. What we are seeing in Asia, especially, is you are seeing definitely a heightening in concerns around the supply, because there's two components to this. In North America, we are facing higher prices, and that's going to impact consumer balance sheets and consumer disposable income. But in parts of Asia, it's not about just the prices that they're willing to pay. There's actually just, in some cases, a lack of supply. So you're seeing some countries actually asking some of their people to work from home, to try to avoid driving if they can, to try to avoid traveling if you can. So you're starting to see that come up a bit more, and I think that's why oil prices are reacting a little bit more today on the lack of new information than they might have 2 weeks ago. But ultimately, again, we are optimistic. We are hopeful that there will be a resolution to this conflict in the Middle East. And
I mean, I'm just looking at one story I saw earlier. European diesel futures hit $200.
Yes, and that's it. Like Europe, natural gas prices, Europe's definitely caught up in it as well, in addition to Asia. They are energy constrained. They are a large net importer. And now their two main supplies, Russia and the Middle East, are compromised in different ways, right? So they're having to try to figure out how to address this. Now, I think there's a group that's now gathering in the UK to try to discuss some kind of solution to the Strait of Hormuz. We'll see. We're watching that very closely to see what the thought process is and what the potential actions could be. But we doubt that there will actually be an outright involvement of military action in any kind. It's going to be perhaps more about negotiation, trying to create that perhaps third-party off-ramp for the two parties of the conflict.
And for the Bank of Canada, the Fed, what are they doing with all this? Because we're now talking about inflation, maybe stagflation, maybe recession, yes. All kinds of words being bandied about.
Roger, I think this is the worst nightmare for any central bank, right? Stagnant to declining growth while inflation's picking up. I think it's important to really highlight that this kind of spike in oil prices is different than perhaps what happened in the 1970s. If you think about typically why central banks would increase rates when inflation is high, it's in order to reduce demand, to kind of pull back demand in some way and hopefully moderate and slow the economy down. In this case, the spike in oil prices is due to a disruption in supply. And in a way, again, we're starting to see already the impact on consumers' balance sheets and consumers' wallets. So in a way, we think higher oil prices will destroy some of that demand itself. So I think both central banks, the Fed and the Bank of Canada, recognizes that. So they don't feel like higher rates will necessarily need to be the solution for higher oil prices, because that demand piece will naturally slow down or be destroyed itself. Specific to Canada, though, we also have a little bit more softness and spare capacity in the economy, which is just a different way of saying we do have an economy that has a little bit more weakness. We do not need to hike rates to try to slow down demand. The Fed does have a bit more of a complex picture, but we think that the higher energy prices, the fears about higher inflation, it isn't really transmitting to long-term inflation expectations yet. We think what this does is probably delay the cuts. If you look at what the bond markets are telling you, February 27, 2026, it was pricing in 2 cuts towards the end of this year. Right now, it's not pricing in any cuts until probably mid to late 2027. Now, the bond market's also pricing in hikes for the Fed and the Bank of Canada by the end of this year. But again, as we just discussed, we don't think that's the base case because we think that higher oil prices itself will do that demand destruction that higher interest rates would typically do.
Okay, we have to wrap it up there. But Christine, thank you as always for joining us.
Thanks, Roger.
Christine Tan is portfolio manager at SLGI Asset Management. Well, the U.S. is also raising concerns over Canada's Buy Canadian policy, calling it a trade irritant as cross-border trade talks continue. For more, CTV's Mike Lecouture filed this report.
The country's iconic symbol of democracy will soon be protected by Canadian steel. During the next phase of renovations, the Peace Tower will be encased by steel scaffolding from Hamilton-based Walters Inc. But it may not have happened if not for the Buy Canadian provision.
It would have been more difficult, and the chances are that much of the material, at least the raw material, would have come from the United States as opposed to from Canada.
As of December of last year, the government mandated that publicly funded infrastructure projects should prioritize Canadian workers and industries. Even though the U.S. has a similar provision, the American trade representative cited Canada's version as a trade irritant. The Minister for Canada-U.S. Trade downplayed the list of irritants, saying talks are continuing.
There was a high-level meeting this week in Washington between senior officials from Canada and the United States to discuss these and other issues. So none of this is surprising to us.
The removal of American liquor off many provincial store shelves is also on the list of irritants, as is Canada's Online Streaming Act and the supply management system, which restricts the import of American dairy, poultry, and eggs into this country. Meantime, Mexico is seemingly further ahead in trade negotiations with the U.S., engaging in technical discussions with the Americans.
I think the Canadian government is stalling for time. They think that Trump, my guess is they think Trump is weak. They want to sort of see if they can get this deferred into the midterms.
Minister LeBlanc says he'll continue to speak regularly with his American counterparts about the CUSMA review, even as the deadline to decide the deal's fate is just 3 months away.
And that was CTV's Mike Lecouture. Still ahead, Elon Musk's rocket company SpaceX has reportedly filed to go public. We'll have more on that after the break. U.S. President Donald Trump addressed the nation and the world and sent mixed messages about the war that the United States and Israel launched against Iran a month ago. In his speech, he said the war was nearing completion before repeating that the U.S. might also escalate by hitting Iran's power plants if there's no deal. For more on this, we're joined by CTV's Kamal Karamali. And Kamal, thanks as always for joining us. Trump giving an update on the situation in Iran. What are the highlights, or are there highlights of it?
Yeah, absolutely. We're talking about a 19-minute speech where, in essence, Roger, he really defended the U.S. Israeli strikes in Iran and the move that has lasted about a month now in terms of saying and touting it as a successful mission so far. But as you mentioned, there are contradictions here, saying that even though this mission is nearing completion, there's going to be an escalation escalation, or likely an escalation in the next 2 to 3 weeks, calling it sending Iran back to the Stone Ages where they belong. So some strong language there. But Trump really taking this time to address the nation and really boast about how what they've done in terms of what he said is disarming and disabling the Iran forces, talking about really what they've done in terms of and what they might do further in terms of taking down some of their energy sources, as well as he also spoke about how they've dismantled their ability to create some of their nuclear or facilities as well. Have a listen to a little bit of what Trump had to say earlier or last night.
Yet if during this period of time no deal is made, we have our eyes on key targets. If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, because it would not give them even a small chance of survival or rebuilding. But we could hit it, and it would be gone, and there's not a thing they could do about it. They have no anti-aircraft equipment. Their radar is 100% annihilated. We are unstoppable as a military force.
That address, Roger, is really a game plan on how this war might come to an end, or an exit strategy as well. You know, his critics have been very vocal in talking about, especially when he's saying that this war is coming to an end, how that will take place, or what if the regime change is still the main goal, Roger.
And also NATO, he's been critical of NATO lately. What was the latest on that?
Yeah, that was earlier that day, and once again reiterating the threat that he and the U.S. are going to pull out of NATO, which would be a big blow, seeing how big of a role and the sheer size of the United States. But what he said was that NATO is a paper tiger, implying that it is weak, and saying that they really haven't supported the United States in this war against Iran, or have done their part in clearing up the Strait of Hormuz, really throwing the blame at the NATO allies as to why oil and gas prices have been skyrocketing. And so really pointing the finger at the NATO allies, saying you guys aren't doing enough to support the United States, and if this continues, the United States is going to pull out. The question now becomes, Roger, is this a credible threat? Now, we know a 2023 U.S. law requires Congress, 2/3 of the Senate, approval to withdraw from NATO. So experts really say right now it's unclear whether the president even has the power to bypass this, so it could trigger a constitutional fight. We'll just have to wait and see if these are just words or if there's actual action involved.
Okay, Kamal, thank you for that. CTV's
Anytime.
Kamal Karamali. Coming up, we'll bring you some of the details on SpaceX reportedly filing to go public. More on that after the break. Well, SpaceX has been rumored to go public for years, but the wait may finally be nearing an end. Reports suggest the company has made a confidential filing toward a potential IPO. To break down what this could mean for investors, we sat down with Jeff Parks, CEO and Director of Stack Capital.
When you look at this, you have three segments in this business. We have the launch capability, we have the Starlink side, and then we have obviously Mars and XAI as well in the business. So there's a lot of levers for growth. There's been a lot of CapEx built up in this business, which allows it to have a lot of high margin free cash flow and growth going into the future. So I think they can substantiate this underlying valuation, and we think it can trade quite well in the public market.
Where do you see the biggest growth for them? I know they have a number of government contracts, for example, but walk us through where you see the biggest growth.
They do have government contracts with NASA, but that's because they're really good at what they do in terms of underlying business and delivering product at the best possible price to those underlying operations. But I would say the biggest growth and where we get most excited about is on the Starlink side of the business. You have 2.8 billion people in the world that don't have access into internet. So when you're thinking about this company, you need to think about just the Starlink portion as almost the worldwide telco carrier. You can touch pretty much anywhere in the world with that underlying Starlink business. And you're just touching the tip of the iceberg. With 10 million subs right now, that 10 million subs is growing quite quickly. So we're extremely excited about the underlying growth of Starlink.
Remind us why Musk is pursuing an IPO right now. How much of this is about data centers in space?
A big proponent, like you can see a big proportion of it. You can see how much capital is going into the data center space on Earth right now. There's only so much energy that we have. When you go up into space, obviously abundant energy. You're sitting there with solar panels on these underlying data center factories within the sky. So a cheap cost of power. Additionally, on the cooling side, extremely cold up there, so we don't need to run liquid cooling technology down here on like we have to do on Earth. So I think there's a lot of capex that's going to be needed to be able to put those underlying data centers into space.
Okay, we know there are new rules that cut down dramatically how long it takes to get listed on the NASDAQ. How long has it been cut down to? What was it before?
Yeah, conventionally, it used to be after 180 days, a stock would be picked up into the underlying index. Think of the S&P 500, think of the NASDAQ 100. If you can get your stock into those indexes, that can really propel the growth and the value of your underlying share price. So before that 180 days, that was the old world. Now, because SpaceX is so large and because these companies are staying private longer and longer and longer, they're allowing this change where after the first 15 days of trading, they will allow these companies into the index. So that's a big change, and SpaceX getting that option. That's going to make the IPO, in my opinion, an extreme success because there's so little stock to be able to be traded. I know people are saying $75 billion that he raises. Well, you have to think about the amount of passive capital out there in the market that's going to be buying just that $75 billion that's going to be tradable.
Okay, what prompted this move to cut down the time? Was that specifically catering to the SpaceX IPO?
I think a lot of those indexes and exchanges want to win the business and want to have that company in the index. And you also have to think about, like, this is a $1.75 trillion potential IPO. That's a big business. And for passive individual investors not to be able to have access into it because they have to wait the 180 days before it gets picked up into the index, I think it's a great move. And I think it's a great move for companies that we invest in, where our whole thesis is companies are staying private longer and longer and longer. And because this is happening, when they go out there, they're going to need that demand coming from the indexes because they are such large businesses.
Do you think then, based on what you're saying, it'll attract more IPOs? You mentioned a lot of private companies have been staying private longer. Do you think that'll change the dynamic?
I think this is a really good dynamic for people to realize that, wow, we can get picked up with that much buying demand very quickly as opposed to waiting that 180 days. I think it'll attract some other big names from OpenAI to Anthropic to Stripe. Those companies are sitting there looking at this SpaceX IPO and being like, wow, that's a lot of buying demand that's going to come into the market for a large company.
The opening bells are coming up next. And there are the opening bells for this Thursday, short work week. Got the NASDAQ Nano Nuclear Energy ringing the opening bell. It's submitted a construction permit application to the U.S. Nuclear Regulatory Commission for its Kronos MMR microreactor. Becomes the first commercially ready microreactor developer and the third commercially ready Generation 4 advanced reactor developer to submit a CPA. And on the New York Stock Exchange, SmartStop Self Storage ringing the opening bell there. It is the one-year anniversary of its IPO. Time now for the first 15. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity markets. And no real surprise after that speech by Donald Trump last night. We were expecting this. You can see a quick start into the red after the gains of the last few days. The TSX down by 1.1%, S&P 500 off by 1.25%, and the Nasdaq 1.7%. And earlier during futures, it was trading down over 2% at one point. And let's take a look at what's happening on the TSX. You can see it had flirted with 33,000, but with the drop today, it's dipping well down below. And some of the first stocks we want to take a look at for the day to see how they are doing. Let's move into MDA Space. Of course, it is a major builder for components for Globalstar satellites, which Amazon is reportedly in talks to buy for $9 billion. And today, though, the market's reacting, paying the price, I think, for everything else, but it's off by about 3% on that news. And for movers south of the border, we're joined now by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. And we're taking a look at a few stocks here. And thanks, as always, Jeff, for joining us.
Yes, my pleasure.
All right. Micron and SanDisk, they've been taking a hit, but that's always a chance for somebody else, isn't it?
It's at least the way Mizuho Securities sees it. They see these two companies as potentially a buy and are encouraging investors to continue buying even though they've been sold off very sharply. Now, it's worth noting that these are two of the worst performing stocks in the S&P 500 today, even on a day when we're seeing a lot of selling pressure. They were down 6% and 5% in the pre-market session. These two companies have been under a lot of pressure, and the entire space has been under a lot of pressure. Not only kind of amid a broader sell-off in the market, but also because Google, we spoke about this last week, Google came out with a new, I guess, compression software, compression method, which would supposedly reduce the amount of need that the company would have, and potentially others would need, for memory space. And so when you reduce the need for memory space because you compress files better or more efficiently than you used to, all of these memory stocks that had previously been darlings suddenly take a big hit, and that is what happened to these two stocks. Now, Mizuho Securities, again, saw that instance from Google, that new compression technique that Google is kind of championing, and saying that they believe that in the long run, this will actually be a good thing for the memory stocks, that in the long run, this additional efficiencies may drive more demand. It's a good thing overall. Investors maybe see it a little bit differently. The stock is down, both stocks are down, and worth watching over the course of the trading day here.
Well, you would expect these companies to be looking to try and integrate things like that into what they do, I imagine. I hope.
I'm sure they hope so too. That also seems to be the hope for Mizuho Securities, but investors not convinced yet. We'll see.
Not yet. Okay, and Melius getting an upgrade. War is good for business sometimes.
Yeah, RTX is the company here that's getting the upgrade. Melius sees what's happened with the Iran war and is listing a number of things that the United States government and the Department of Defense are going to need to replenish when eventually the war wraps up, or potentially even if the war continues on. Missiles, interceptors, radar defense system, other systems that have been damaged in the now month-plus long conflict in Iran. The United States is going to need to replenish, and potentially allies may need to replenish as well. And so as a result, you get an upgrade here from Melius to buy from hold on RTX, which is a maker of all of those military hardware items that I just mentioned. Melius sees high single-digit growth for the company over the course of not only the next year, but through 2028 as a result of this war and all of the equipment that has been spent in it. So upgrade from Melius, one worth watching over the course of the trading day. And indeed, the defense stocks have been rising since the war began about a month ago.
Did I not see a report at one point they dipped at one point too, though, the defense stocks?
Yeah, it's been very, very volatile, because we have these conflicting headlines. Indeed, I mean, just the course of yesterday was kind of a case in point. You have conflicting headlines. The war may be over in 2 weeks. The war may be over in, sooner than expected. But instead, then the headlines become vague, timelines become vague, and these stocks, which have been a little bit of a yo-yo, up and down, kind of like the energy stocks, but maybe a little bit less. The moves have been somewhat muted compared to the energy stocks, at least. This is one that has been volatile and worth watching, the entire defense complex. It's definitely worth watching over the course of the trading day. At least Melius sees this as more of a long-term gainer here.
All right, at times it's starting to feel more and more like Dr. Strangelove. Jeff, thanks as always, sir. Have a great long weekend.
Thank you, you too.
Jeff Morgan is Deputy Team Leader for the Bloomberg News Equity Team. Coming up, we'll check in on the markets and get some ideas for your portfolio. Stay with us. Rising oil prices and uncertainty over the end of the Iran war are making near-term market directions challenging for investors. Let's find out if there could be some upsides over the long term. Joining me now is Andrei Amalchuk, the founder, CEO, and CIO at Lion Capital Management. Andrei, thank you very much for joining us today.
Thank you, Roger. Great to be here.
Okay, so I'll ask the question, because how would you characterize market risk right now? And literally, when I say right now, I mean at this minute, because in 4 minutes at the end of this interview, it may have changed.
That's right. Well, things are changing fast. We get a lot of news from tweets. We get President Trump's speech yesterday, which did not provide much confidence to the market at all. Clearly, oil prices are up more than 10% this morning. Market is down this morning as well. So there is a clearly renewed fear of escalation, and the duration of the conflict might last longer. So that's what the market is pricing right now. There's not much visibility as to how things are going to be unfolding. And clearly, the big question remains whether or not the United States are going to go after the islands that are critical to the Iran's oil supply. That's the biggest question on my side. So clearly, market reaction is warranted, given what's happening right now.
And with oil, we've seen it jump 11, 12% today on that speech yesterday. Is this that moment? Because people have talked about maybe hitting 150 a barrel. Is this that moment that they're looking and going, this may take longer than we thought, and oil prices are now really going to react to it?
Well, it's very possible that we get an oil spike in the short term to the neighborhood, in my opinion, of 150 to 170. But that would happen only if there's a real big escalation still happening from this point on. Should that happen, I think that would mean that U.S. is going after some of the island facilities, and then it will be a question of the response from Iran. What can they do to respond to those escalations? Now, longer term, that would lead to the quite a bit lower oil prices. So in my opinion, that would be a major opportunity to take some profits for those who are exposed to the oil markets. And once again, that's not a certainty, but the odds of that are certainly increasing in my books.
So where are you looking right now? What sectors do you see opportunities?
Well, despite all this uncertainty, number one thing you want to do as an investor is to stay invested and don't try to predict the short-term dynamics, and to be opportunistic, take advantage of the market volatility. So I see a lot of opportunities right now in the defense sector. Clearly, defense budgets have been increasing globally, not just in the US, but also in Canada, especially in Europe as well. So there are a lot of opportunities there. These are structural step changes. This is not something that's going to change, with a change of presidency, for example. So these are long duration changes that we can extrapolate from, and a lot of companies are benefiting tremendously from that. Within the same theme, you can think of need to have domestic capabilities, sovereign capabilities. So the companies that are based within respective countries stand to disproportionately benefit from the capital flowing into the defense space.
And I just want to go back to defense for a second. It has been a bit of an up and down ride for it, though, too. I mean, it's experiencing that as well.
Yes, absolutely. So you have to pick what you invested in. A lot of companies have really rallied a lot, even last year, the companies that are exposed to defense space. So you have to pick and choose, but at the same time, it's nice to get a huge structural industry tailwind, which is nowhere close to changing. In fact, it's going to accelerate, in my opinion.
Okay, and areas that you're staying away from right now, and I guess we forget sometimes with Iran being such a focus, the rest of the world's unfolding still too. AI still a factor for everybody.
Well, artificial intelligence has been top of mind for a lot of people. Software as a service companies' valuations in many cases have been cut in half. So you have to be very careful. In my opinion, mission critical SaaS companies that are truly embedded in companies' operations and very difficult to take apart and take away, they're actually net beneficiaries from artificial intelligence developments. But companies that are prone to major disruption, that are not mission critical, that can be changed quite easily, they're prone to major disruption. So as a result, you have to really look case by case, subsector by subsector, and evaluate whether these companies will be prone to disruption or not. So I can give you an example. For example, placement agencies companies, I'm quite negative on. Clearly, we can discuss the whole macro situation and the hiring trends, but also artificial intelligence is prone to disrupt some of those businesses and to create additional competition, as well as companies are using some of those AI tools to really hire people themselves. So don't need to pay the placement agent as much as they used to.
All right, that's a good segue into some of the stocks you're keeping an eye on. One of them, though, that you want people to keep away from is Robert Half, involved in placement.
Yes, in my opinion, Robert Half is the company you have to be careful. Clearly, the stock has been under tremendous pressure over the last 12 months or so. That's fully warranted, in my opinion, and I cannot make a bullish case yet to get involved with this company or the whole industry, as a matter of fact. So it's more thematic positioning, company that's prone to disruption and also does not benefit from the whole developments as it relates to the macro and overall impact on the economy.
Okay, we're almost out of time. We want to get in one of your buys, Bird Construction.
Yeah, Bird Construction is a prime beneficiary of Build Canada trends. It's an infrastructure company that is positioned to benefit tremendously from all the capitals, going into that space. They're also exposed to the defense to a small extent. They have a booming backlog, up 45% year over year, as a matter of fact. They have an expanding margin profile. So everything is working in their favor, good free cash flow generation. And you even don't have to make a case for the margin expansion for this company to work nicely over the next 2 years. But in my opinion, given a multi-year structural tailwind with the capital flowing into the Building Canada and boosting our sovereign capabilities, I think the multiple expansion for Bird as well as for the rest of the infrastructure companies in Canada is very much in order.
Okay, we have to leave it there, but Andre, thank you very much for joining us today.
Great to be here. Thank you.
Andre Omelchuk is founder, CEO, and CIO at Lion Capital Management. Just ahead, how rising fuel costs are rippling through supply chains and why one retailer thinks there isn't much more he can do before he's forced to raise prices. A Vancouver grocer says he is doing everything he can to hold the line on prices, but warns he may not be able to do that for much longer as rising fuel costs ripple through the supply chain. CTV's Andrew Johnson has more.
It's a chicken broth.
As he stocks the shelves alongside his daughter, David Lee Quen knows there are tough decisions ahead.
I am worried that if this continues, I can't take care of my family.
The war in Iran and resulting surge in gas prices have already increased costs at his Vancouver store, but Lee Quen is leaving the prices alone for now.
We want the customers to still shop here, because if you put up your prices all the time, it's not good.
But independent grocers like this one can only absorb so much. The Canadian Federation of Independent Grocers says shoppers should brace for higher prices.
We're already getting notifications of price increases, and in some cases, some of the distributors of products are tapping on surcharges, fuel surcharges.
The price I saw on the way in this morning was $269.9 for diesel.
Dave Earle represents truckers in BC and says what's passed on to shoppers can depend on what is being shipped.
If it's a load of electronics that's worth $2 or $3 million, the extra, $500 to $700 in fuel it doesn't make much of a difference to the end cost of the product. If it's a load of lettuce, that's very different. Death of 1,000 cuts. Everywhere you go, everything is a few cents more.
Everyone we spoke to expressed hope for a quick resolution in Iran and a return to normal for oil prices. But they also acknowledge even if that happens, there will be a lag and grocery prices could remain inflated for months. Andrew Johnson, CTV News, Vancouver.
Canada's international trade minister is in Asia, talking up Canada as a reliable supplier of energy. We'll hear from him next. Canada's international trade minister, Maninder Sidhu, says Canada is a reliable, stable supplier of energy. He did so during an interview with Bloomberg TV this morning, adding that the country is going to be there to support the global energy supply. Have a listen.
Supply chains are being tested right now, as you know, with the global energy prices increasing here in Seoul. The conversation has been around energy and what more Canada can do. And as you know, Canada is a reliable, stable supplier of energy. If you look at crude oil, LNG, but also nuclear capacity, we have all that. And so we're getting a lot of calls these days from countries all around the world for more of our energy supplies, and we're going to be there to support that.
The question really is to what extent Canada can fill that gap.
Yeah, look, if you look at what the projects that we have in the pipeline, we have LNG Canada 1, we have roughly 6 projects in various phases of development, and so we are increasing our capacity to fill some of that gap. But again, investors that are calling us now from all around the world are saying, how can I get in the next project? How can I secure, the next 10, 20, 30-year supplies in LNG, in crude oil, and in nuclear? And so those are the conversations that we're having. Of course, we're ramping up quite quickly through our major projects office, and we have about $96 billion of investments pouring in just last year alone. That's important to put that into context, Linda. It's the highest amount in 18 years. And so you're seeing this seriousness from investors to invest in Canada, and we're driving that hard through government policy as well.
Minister, we know for the short term, there is little Canada can do to ramp up production. But for the longer term, do you think this Iran war could push Canada to become perhaps an energy superpower? What are the plans, if there is such a plan?
Well, there was already a plan in place before this turmoil. We formed government last year. We brought in our major projects office, but we also brought in legislation to get projects built faster in Canada. That's energy, mining, infrastructure projects permitted within 2 years, working with our provinces, territories, and Indigenous communities. And so this is why you're seeing that demand of investors pouring into Canada. We've got 6 projects on the line that are being built up. But if you look at where we came from last year alone, traditionally, most of our energy supplies were going to one particular country. Last year in June, that changed. We had LNG Canada 1 that came online, and since then, and from Kitimat, BC, we've got 50 shipments that have already been sent out to the Asian markets, including many here in South Korea, and they're ramping up their production. They're hoping to do a phase 2 of that. Once phase 2 is developed and built for LNG Canada 2, that will be the second largest LNG facility in the world. So Canada is really ramping up.
We heard from President Trump just today that, he was urging countries not to rely on Middle Eastern supply of oil. He talked about how the world should rely on the U.S. instead. Where does Canada fit into that oil supply chain, you think, in the coming years?
Well, I think Canada has a advantage, a very competitive advantage. If you look at our transit times to the Asian markets, from the Gulf of Mexico, it's almost double or triple the transit time from Canada, from our west coast in British Columbia to Asian markets. It's 10 days. Our prices are very competitive, and so when you look at where Canada stands in world energy production, we are there. We're ramping it up, but we're also very competitive, and this is why the conversation, even here in South Korea, is around energy. As you know, KOGAS Gas is one of the largest natural gas companies in the world. They've invested in LNG Canada 1. They're looking at LNG Canada 2. And these are conversations wherever I go in Asia. I was just in India a few weeks ago with the Prime Minister Carney, where we had a great conversation with Reliance Industries on Canada's energy capacity. And they're also looking at opportunities in Canada because, as you know, as Asia grows, particularly in building out data centers, there's a focus here in Korea on AI. They need energy to power that growth, and we're going to be there to supply it.
Speaking of Prime Minister Carney, he had a conversation with President Trump today. What transpired? Is there anything you can share with us?
Yeah, I mean, look, they talk from time to time, and today was a celebratory moment for Canada. Our astronaut, Jeremy Hansen, which is the only Canadian as part of the mission to the moon, was there, so that was part of the conversation. But again, coming back to the U.S., they are our #1 trading partner. They're an important trading partner, and so, those conversations will progress. My job as the Minister of International Trade is look beyond North America, and the world has, the world is looking to Canada, and we have a lot to offer. In this trip alone, we signed over $1 billion of commercial deals. One particular example I'll give you is Prairie's Lithium, which is a resource provider in Saskatchewan, Canada, partnering up with a Korean technology company here to further process and refine lithium. Once commercialized, it will be the only processing lithium facility in North America. And so that's just one deal, but there's many more signed on this trip as I'm leading this trade delegation in cybersecurity, in blockchain, and others. And so to me, this is about making sure that Canada is there. And it's really presenting Canada as a stable, reliable trading partner. And you're hearing that from partners all around the world as you're seeing these influxes in energy. People are turning to Canada saying, look, Canada is reliable. Let's talk to Canada. And those are the conversations that we're having.
Minister, talk to us about the deals you're signing in Korea. We know that you've been meeting with a lot of the companies there. Can you specify which companies in particular and what deals and the kind of investment they're looking to make in Canada?
Absolutely. Look, Korea's largest companies we've sat down with Hanwha, Hyundai, KOGAS, Samsung, LG, and so those are companies that we're looking to do more partnerships with. I just mentioned KOGAS as an investor in Canadian LNG project in Kitimat, BC. They're looking to do more. But again, coming back to the commercial deals, it's about energy, but it's also about critical minerals. And as I just said, the Prairie's Lithium project is very important to Canada. As you know, Prime Minister Carney launched the Critical Minerals Alliance at the G7 in June to really focus in on supply chain resiliency. And so that's what we're doing with like-minded partners, including our partner here in Korea, to talk about what more we can do. We're very blessed with resources, but of course the technology partnerships need to be there with Asian countries, and that's some of the deals that are coming out of this trip.
Just ahead, oil prices are moving today. We'll find out why with our next guest after the break. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Oil prices are surging today after U.S. President Trump said strikes in Iran will continue. In a primetime address delivered last night, Trump said U.S. forces have significantly weakened Iran, calling the military campaign unstoppable. However, Trump added, operations will continue until objectives are fully met. The U.S. president also threatened to strike Iran's electric generating plants if a deal isn't reached. Canada's trade deficit widened sharply in February, missing expectations. Stats Canada says the trade gap grew to $5.7 billion, the largest since August. The move came as imports jumped to a record high, driven largely by a surge in gold purchases from the United States. Imports of metal and mineral products climbed more than 45%. Stellantis is exploring plans to build electric vehicles in Canada with Chinese partner Leapmotor. If the plan goes ahead, it would be the first major Chinese auto investment since Ottawa eased tariffs earlier this year. Discussions are focused on the automaker's idled Brampton, Ontario plant, though talks remain in the early stages. That's Bloomberg News first reported this plan, which was later confirmed by the union Unifor. And turning to the markets, you can see the reaction, although not as bad as what the day started out. Who knows where it'll end, though. But right now, TSX off by about 0.4%. A lot of that, of course, is reaction to what Trump said last night. Turn to the U.S. markets, and we will see a similar situation. They are all off, although they're bouncing back a little bit, clawing back some of those losses. The S&P 500 off by 0.87, the Dow by about 0.95, the NASDAQ by 1 1/4. Now, going the other way is oil, all on reaction to Trump's comments and speech last night. And oil is up, WTI up 11% at $111 a barrel. Yeah, oil prices seeing all kinds of movement today after that primetime speech last night where Trump vowed to escalate the war in Iran. Here to discuss this and other market trends is Sam Labelle, portfolio manager at Veritas Asset Management. And Sam, thanks very much for joining us today. Let me just get your thoughts on that speech. What did you think of it?
Well, if the idea was to tone down the rhetoric, obviously that didn't happen. And it seemed to contradict some of the things that have been said in the last couple of weeks that made the market a little bit more comfortable with at least some resolution. But what we always point to in these things is to take a look at the December oil contract, because by that time, hopefully, this conflict will have resolved. So that December contract signals what the oil market, at least what the market thinks the oil market will look like in December. And it's still trading in the 70s. So we would argue that that really signals a return to a relatively balanced and normal market. So as much as we're looking at the near-term oil price, and it's spiked quite a bit, we all know that there are literally big problems right now with the Strait of Hormuz and with getting the oil to market. But if we look at that back-end contract for December, it's still trading in the 70s. So the market believes that this will resolve in some way, at least in the next several months. And we'll see whether that proves to be the case, but that is kind of the base case that we assume will play out.
Now, in Europe, though, we're seeing diesel futures topping $200. Are these two completely different paths for oil?
Well, obviously, North America has its own supply of oil. Canada and U.S. production almost makes us self-sufficient, not entirely self-sufficient. There's still some oil coming in from the Middle East in North America. So you will see a dislocation between the Brent price, which reflects the price that's being seen in Europe, and the North American price, because Europe gets most of their oil from the Middle East. So any interruptions in supply will definitely be felt in Europe sooner. And ultimately, that spread between Brent and WTI widens. That might take some time to come back in line. Typically, it'd be $5 or $6 a barrel. It's spiked quite a bit.
Now, and with those price pressures in Europe, could we see any of that being pushed over into North America? Not necessarily oil, but in other things.
Well, it is a global price for oil and for the refined products. So as much as there is a bit of a discount on WTI, that reflects supply that's available to refine. But at the end of the day, the final product prices trade off of global oil prices. So you tend to see that refiners are able to sell at a Brent-linked price, whereas their input costs might be WTI-linked. So we will see increases at the pump. The pressures in Europe will be felt here in North America on the final products. And one of the concerns that we have is that leads into a number of different industries where oil or diesel is an input. Mining, for example, is one area where you do use a lot of diesel. And so that can lead to some cost pressures as things creep up on the manufacturing and mining end. And ultimately, that's already being felt a little bit in long bonds. The increased threat of inflation is creeping in, and so that long bond is starting to creep up, and that can affect all sorts of different investments that you have that might be linked to that 10-year yield. So kind of bond proxies, yield-oriented investments like telcos or REITs. To some extent, utilities, all the utilities are benefiting from increased demand from AI and from other build-out. So you do see some pressure there on the interest rates in the long end, and that's something we're watching very carefully.
And is that what has you lightening up on telcos and REITs?
Yeah, we've been lightening on telcos for a little while. I mean, there has been a pullback here in population growth. That's a big driver for new subscriptions on telecom. So they're struggling a little bit. There was some really good valuation discounts in the sector about a year ago, but now as we look, we're starting to see things a little bit more richly valued. So we have been lightening up there. And of course, we are concerned about that long bond effect. And we think telcos are kind of at the forefront there of pressure.
All right. There's been some repricing in energy equities along with the oil. Are we done with that, or is there more to come?
Well, I think that if you look at the free cash flow yields and kind of traditional valuations off free cash flow yield, most of the oil names, the big large caps that we would be interested in Canada, their free cash yield kind of signals a price in the 70s. That's where the long end of the curve is. But then you're getting a free cash yield anywhere from 9 to 15% for some of these plays. So that, to me, that's a really good place to be. All that capital will get returned to investors. And with oil sands, you do have a long life asset. So if you're worried about energy, I don't think necessarily you should be worried about it collapsing back to $60. So this is we're comfortable holding it here. We're not necessarily adding to our position because we think oil could end up on the back end. It could end up in the high 70s, and that would be good for share prices here.
All right. I want to get a couple of stocks that you're liking still, Cenovus and CNR.
Yeah, so Canadian Natural Resources is one of them. It's a producer that has lots of growth and a history of capital discipline. Less exposed to the integrated side. We'd like to mix in a little bit of integrated. The other name, Cenovus, does have integrated. It's kind of been a bit of a struggling entity for a while, but I think it's started to come into its own in terms of turning around the operations. And so that's been a net positive for them is the turnaround in the downstream operations. Both of these companies are good long-term plays, we believe. A little bit of growth and good steady free cash flow. And that's mainly where we're invested. We do have a few smaller cap names like ARC Resources and Tourmaline, but to kind of round out the portfolio.
All right, just a couple more things I just want to touch on quickly. Gold. Where do you see it going? What do you see it doing? It's kind of been bouncing around.
So gold's been a tricky one. I mean, we've been following the gold rally here and been participating in it right up till the present. But one of the things we watch carefully is the different sources of demand for gold. So recently, there was a lot made of the central bank move into gold. So they were buying fairly steady volumes at increasing prices. So that was driving the demand side from central banks. But in the last year or so, the demand side has really been taken over by ETF buying. So inflows into gold ETFs. And that's more of a speculative activity. People are chasing the rally in gold, and that's really accentuated the move. And we kind of saw a parabolic move up in moves into gold ETFs in February. And now this month, we've actually seen an outflow of gold ETFs and net selling. So that's been part of the pressure that you're seeing here is that the ETF layer is kind of pro-cyclical. It follows whatever the market's already been doing. If there's been great returns, people tend to chase those returns and put more money in. So what we're watching now is whether that 1 month trend of outflows from gold ETFs turns into kind of a more sustained sell-off in ETFs, and whether that source of investment demand kind of ebbs a little bit. And the other thing to worry about is that, as I mentioned, the diesel prices feeding into miners' costs, rather. Those diesel prices could push up prices and fuel costs. So the mining costs could be a pressure for the producers. So we've actually been moving more towards streamers that don't have the operational exposure and away from some of the more traditional big cap names like Barrick and Newmont. Good companies, but ultimately we think that there is some pressure later on in the year from a cost push perspective.
Okay, now we're out of time, but I do want one quick thought on, we'll go from gold to champagne, the finance minister type, the visit to China. What kind of an impact do you think that will have on Canadian industrials?
Well, it's an interesting move because obviously with the Iran war happening, the U.S. has backed off of their meetings with China, and it's kind of slipped in there. Maybe this was planned a long time ago, but we slipped in there and started and sent a fairly high-level minister in the finance minister, Mr. Champagne, to China to have meetings, and accompanied by several of the insurance companies who would like to do a little bit more business in China, Manulife and Sun Life, to be specific. But ultimately, the U.S. has signaled that they will back away from kind of politicking in the Hormuz after the war or conflict ends. They plan to not be as involved, and that leaves a power vacuum. We think China moves in. They're much more dependent on shipping through the strait in terms of oil and other products. And if China is kind of filling that role that the U.S. is backing away from, Canada would like to get a little closer with China. It's sort of under the diplomatic radar a little bit to send your finance minister, but we do note that Mr. Champagne has experience both in trade as trade minister and in foreign affairs. So I'm sure that trade and will not be the only thing discussed at these meetings. And generally, it'd be good for Canada to keep the dialogue going with China.
Okay, we have to wrap it up there, Sam, but thanks as always for joining us.
Thank you.
Sam LaBelle is portfolio manager at Veritas Asset Management. Up next, will the Iran conflict force the central bank to change the lending rate? More on that in a moment. Whether or not the Iran conflict is over, it is likely to affect inflation, at least in the short term. In a new report from National Bank Financial, some argue the central bank should exercise patience in its rate decision instead of responding to the current oil shock. For more, we spoke with Warren Lovely, Managing Director, Chief Rates and Public Sector Strategist at National Bank Financial.
I think what is fair to say is that we're studying that earlier episode, and we know what happened. It generated a lot of inflation. We saw a lot of fiscal stimulus added as well, and the economy overheated, and we had a real inflation problem, which is, to some extent, I think what investors have in the back of their mind when we're trying to discount what this current oil price shock might mean for the economy. We will get more inflation. Of that, we can be certain.
Okay.
But what we're trying to argue here is that it might be premature to overreact to that oil-induced inflation spike because there's a lot of vulnerability here in Canada still.
Let's talk a little bit about that. One of the cautions is about the soft labor market. Do you expect the labor market to continue and carry on to be weak? I do. Yeah, I mean, one of the fundamental differences here between, now here in 2026 and 2022. In 2022, the global economy, the Canadian economy was really powering back up. Here we have just an underlying economy that looks quite fragile, weak in the labor market, in the housing market. But specifically to your question on hiring, we've had some mixed signals in terms of labor market fundamentals, but Canadian firms don't seem to be hiring in significant numbers, and if anything, they may be cutting their headcounts. There doesn't appear to be significant hiring intentions. There aren't a lot of job vacancies out there. So I think what Canadians need to be prepared for is that the labor market is going to remain fragile. The unemployment rate's probably going to continue to trend higher here. And that's a real concern for the consumer sector. And we're already seeing some signs of stress in terms of Canadians being able to service their mortgages, which is another underlying vulnerability we have to contend with here. Okay, we'll talk about the delinquencies in a moment, but you know what the housing market has been like for the past while. It has been down, it has been dragging, and a rate cut, of course, could boost investment in the housing market.
Well, and the flip side, I think, also holds rate hikes, which is what market participants have been quite willing to aggressively price in, could seriously erode prospects in the housing sector. So look, let's be blunt. Canada has an interest rate sensitive economy. We have a housing centric economic model in this country. We lean on housing to generate a lot of economic activity. We normally expect when interest rates go down that housing shows some signs of life, but we've been really missing a heartbeat in key housing markets, including in the really critical Toronto real estate market. We'll get fresh data on Toronto real estate activity for March tomorrow, but I can tell you that there hasn't been a whole lot of activity in Ontario nationally in the housing market. And one fear we have is that reacting to a short-term oil-induced inflation spike by raising interest rates could further complicate and challenge a housing market that is already struggling.
You mentioned delinquencies for mortgages. Can you sort of share what you've noticed?
Yeah, well, let's be honest and objective here. We don't have a delinquency crisis in the housing market. Canadians generally service their mortgages. This is, one of the features of the financial stability that we have in this country. But if you look at leading indicators and at the margin, what we've learned, delinquencies are moving up from a very low level, and they're not at alarming rates as yet. But it signifies, again, vulnerabilities, fragilities in the Canadian household sector. Most Canadians appreciate, and viewers appreciate, that we've got something of an affordability crisis. Real purchasing power is down. Canadians, particularly homeowners, don't feel like they have a lot of extra dough to stretch. And the other thing that is happening here, irrespective of whether we get further interest rate movements, is that a lot of mortgages are resetting anyway at higher rates, more painful rates. And this mortgage refinancing process that has been well underway for some time is a challenge. It's making life harder for Canadians that are carrying mortgage debt. So I think it's not all that surprising that through delinquencies, we're seeing Canadians struggling to make ends meet and keep up on their payments.
That was Warren Lovely, Managing Director, Chief Rates and Public Sector Strategist at National Bank Financial. Coming up, today's ETF report, one way you can gain exposure to OpenAI's upcoming IPO. Well, there are a growing number of ways you can gain exposure to OpenAI months ahead of its highly anticipated initial public offering. The AI startup, which is widely expected to make its debut on public markets later this year, is joining 3 of Cathie Wood's flagship ARK Invest exchange-traded funds. This includes the ARK Innovation ETF, ARKK. This fund holds a roughly 3% stake in OpenAI, and they don't require a minimum investment and are offered through regular brokerages. Coming up is a new era upon us in markets. Tech stocks are falling and crude prices rising after U.S. President Donald Trump vowed to hit Iran extremely hard. We'll find out after this. Canada's trade deficit widened sharply in February, missing expectations. Stats Canada says the trade gap grew to $5.7 billion, the largest since August. The move came as imports jumped to a record high, driven largely by a surge in gold purchases from the United States. Imports of metal and mineral products climbed more than 45%. Finance Minister François-Philippe Champagne has been joined by Bank of Canada Governor Tiff Macklem and Bay Street executives in China. The Canadian delegation is meeting with Chinese officials to build on the diplomatic reset that occurred earlier this year. The group includes the chief executives of Manulife and Sun Life and the vice chair of BMO Wealth. The talks are expected to include opportunities in financial services and healthcare. And shares of BCE, Rogers, and TELUS are seeing some pressure today after the telecom giants were downgraded by TD Cowen analyst Vince Valentini. Valentini says recent strength in the stocks has been due to investors seeking safety from geopolitical uncertainties. He adds that the aggressively low pricing seen late in the quarter is not fueling volume growth, but rather churn and negative repricing. A reminder, BCE is the parent company of BNN Bloomberg through its Bell Media division. And looking at the markets right now, you can see the TSX actually is kind of clawing its way back up. After opening more in the red now, it's only down by about 0.17. S&P 500, though, off by nearly 0.75 of a point, and the NASDAQ off by more than a point, all of it reacting to Trump's speech last night. And oil, no surprise, is going the other way quite significantly. It's up 11% right now to $111 a barrel. And all of this, of course, in reaction to Trump's speech last night, the conflicting message on the Iran war. He claimed the objectives of the war are nearly complete, but he then also threatened to bring Iran back to the Stone Age. With tech under pressure and crude surging, should you refocus your portfolio? Let's bring in Cole Smead, CEO and Portfolio Manager, Smead Capital Management. Cole, thanks as always for joining us.
Yeah, thanks for having me.
Okay, your thoughts on the speech? I think people were expecting something different.
Yeah, the market in general has really been slow to react to the circumstances that are going, that are afoot right now. I think investors in general thought that this would be a swift, easy situation for the United States and Israel. What they've woken up to is a conflict that's now 1 month in. There's an end in sight, plausibly, but it doesn't look like it's anything short of at least 2 weeks, if maybe not as much as 8 weeks out. And the difference to this and, say, Venezuela is not only the time, it's the pure shock of it. The supply shock that's going on in this case is unprecedented in the history of the world. If you look back at supply shocks in the oil business, it was 6 to 7% was a big supply shock. This is 12 to 15%. And what we think the markets have been slow to do is just react to what is going on in the energy supply. But then secondly, how does that reprice securities in markets? And it's no surprise that we're going from a world where the AI hyperscalers were wasting capital on investment. And the companies like the oil businesses that are just minting money on a daily basis are being rewarded. That's a pretty good paradigm shift in my book. And we think that's a good picture of the new era that's ahead in markets.
And this new era, how long, when do you see it's kind of really taking off, and how long do you see it lasting with the way, is that enough of a change to carry it?
Yeah, well, so this way, dogs chase cars and people chase stocks. I'm 42 years old, been in the business for 20 years. It hasn't changed in 20 years, and I don't think it'll change in my lifetime. And so the nature of this is humans will run after the securities that outperform. And it just so happens that they went from doing that in technology stocks to now plausibly beginning to think about doing that in energy. The difference is that energy begun this whole process, a year ago, less than 3% of most global indices, S&P, MSCI World, et cetera. And if you take the money out of tech and you shove it into energy, it's going to be like shooting a fire hose into a teacup. It's just not possible. And so to see an explosion in price reaction as the ones that create capital or create cash are rewarded is not shocking. But, this is also a meaner version of the United States being the most glorious market in the world, and that being a very narrowly concentrated market, to waking up to a world where other things are catching a bid. One difference, though, is unlike the 1970s, the United States actually benefits from this. We're the largest oil-producing nation in the world. If you think about North America is winning because you need low cost of supply, which it has. And the second factor that we're all waking up to is secure supply. And so North America is benefiting economically in a way that is unlike past situations like this. I think the real question is, in 10 years, who will make money? If I use the 70s and the 2000s as a picture, you made really good money in the energy business. You just didn't make very good money in many other places. And so I think that's what investors are really slow to adapt to.
So where are you looking then with that within the energy sector?
Yeah, the most attractive names into this have been the torque names, right? Who has high operating leverage. And, in some respects, the market from 12 months ago had begun to wake up to the idea that long life assets were more attractive. So you'd seen actually more of a bid in the Canadian names going into late last year. So names like Cenovus, names like Strathcona, names like Imperial that we own, that was actually fairly common. Where there's been the biggest pickup year to date is actually in the Permian names. Those are, in some cases, the highest torque names, because when you only have short life wells, say 7 years, that is where a move in price becomes the most meaningful. Now, I think the question for them all is, are you going to see a meaningful move in rigs? And so far, we're 4 weeks in this conflict, and actually rigs have moved down in this last week. So I think that's the real question. I saw a great chart the other day showing the move in oil over time and the CapEx just not going anywhere over the last few years. The idea at one time was this industry would never get rationale in their capital allocation. Now what's going on is we have some of the best pricing going on, looking back over, say, 20 years, and yet the industry is not willing to use CapEx and invest. It shows you how good of a hand the industry has. That being said, I will not be surprised to see consolidation pick up in this, because ultimately there are big multiple spreads still between the majors, say in Canada or the United States, and the smaller players. They will arb liquidity, and we're going to see that go on even in the next 6 months.
All right, you mentioned Cenovus. You own a big position in them, and you're still liking them.
Yeah, I mean, they're in a great position. They came out and said, post the MEG merger, they said that they're going to take MEG's, former assets production from 108,000 barrels to about 150,000 barrels. Okay. The market has been slow to react to these circumstances. The market believes that we're going back somehow, some way, surely to $60 or $70 oil. That has been the market's bias. What is Cenovus effectively doing? Calling the market's bluff. And I think you're going to see people do that. You think we're going to have low prices? Great. We're going to go out and build up production where it's very cheap for us to do. They're going to meet a world. We're going to find out real quickly that the old $60 barrels, they just ain't out there anymore. And so as we walk into this world, even with low inflation in the next 5 years, a $60 producer is going to wake up with something closer to $70 of cost production in 5 years. And so you just think about where we've been. The last 5-year average on oil, just so you know, was $76 a barrel, even though it went high and it went low. And so if that was, what they call mid-cycle over the last 5 years, what does that mean for the future? The idea we're going back into the 60s or 70s for a long period of time, that's fanciful. We're in a world where it looks like $90 or greater is pretty plausible. And I think the question is, how long do these type of supply shocks last? And how much more uncertain is the supply of these markets compared to what people thought in what was supposed to be a terribly oversupplied glut of oil for many, many years to come?
All right, and some of the torque names in Canada: SCR, IPCO, and TVE. What are the strengths there for you?
Yeah, I mean, the strength of Strathcona is Adam Waterous is a genius. You can just take good capital allocation of the bank there. International Petroleum is ran by Will Lundin. He reminds me a lot of Adam, and they've done a really good job. They're building an asset called Blackrod. We just got involved in them in January. And, we like the oil business. We're naturally not as excited about the gas business because, again, gas prices go low. Oil companies still produce gas. But when oil prices go low, people will stop producing. And so we like the positive convexity of the oil market. We don't own them, but Suncor came out and, said what they're going to do with some of their capital. They're going to increase their buybacks. If I'm an oil company right now, the advice I'd give to all the boards is don't go out and increase your dividends, variable or regular. Just don't do it. Let the cash sit there and then allow yourself to make decisions off that. And at least in the buybacks case, you're not losing 15% of withholding if you're a U.S. investor to the Canadian government or, a larger amount for taxable to a Canadian citizen. So we look at this as like, if you think your stock's cheap, go out and buy it back. If you don't think it's cheap, just sit in the cash and let time, deal with it.
Okay, we have to wrap it up there, Cole, but thanks as always for joining us.
Thank you so much.
Cole Smead, CEO and Portfolio Manager of Smead Capital Management. Coming up, Hot Picks. We'll zero in on 3 consumer discretionary plays after this. Time for Hot Picks, and today we are zeroing in on 3 consumer discretionary stocks. Our next guest has RH as his top pick. Here to break them down for us is Jamie Katz, Senior Equity Analyst at Morningstar. Jamie, thanks as always for joining us.
Thanks for having me.
It's been a rough week for RH, but you're liking it.
Yeah, I think, that you look at a 20% plus drop in the share price after earnings gives it a nice opportunity for investors who are looking to enter shares. I think the biggest problem is that, we're still looking at a pretty heavy investment year, and that has led to a lot of investor concern about profitability and when maybe profit margins can continue to, or return to expansion rather than compression. So we do think there's a little bit of time before these shares get moving. But I think when you look at where the shares are trading now, we really haven't seen levels like this since the beginning of the pandemic, where there was a lot of uncertainty. And I think, there are going to be some costs that roll off next year that are going to allow 2027 to be an operating margin expansion year again.
Yeah, and I mean, this is very different, I guess, from 2020. Do you think what gives you the optimism it'll bounce back?
Well, I think, we've already been made aware that there's probably roughly 300 basis points of costs in this international operating expansion strategy. And those costs are largely coming off next year. So we know that there are going to be some changes to the cost structure that will make it a little bit easier to digest the operating efficiency of the business. And again, I don't think we're looking at a business that's going to grow 20% a year, but they are investing in innovation. They are launching this RH Estates business. It is very traditional. There are a lot of homes that are exposed to that sort of styling in their house. And so I think that gives them an opportunity to continue to grow faster than the market.
All right. Next up, Norwegian Cruise Lines.
Yeah, this is a great turnaround story. It's a business that has really lagged its peer group, relative to Royal and Carnival. They did have a recent activist investor take a stake, and so they've refreshed their board, 5 new members. There's a new CEO at the helm now, and I think there were some sort of self-inflicted decisions that were made that will roll through the P&L and get the business back on track. But basically thinking about how deployment looks going forward, how demand looks, consumers are still cruising, and the appetite for value focused vacations is still pretty high given economic sensitivity.
And what do you like about having the activist investor in there?
I think it just facilitates change at a little bit of a faster pace. And so, again, maybe we wouldn't have had 5 new board members if somebody wasn't out there sort of, shaking the trees over that. But it puts a fresh set of eyes on the business and maybe brings some fresh insight to how the business can sort of accelerate to its next level.
And the new CEO?
The new CEO comes with great operating experience, so I think it will be interesting to see if he makes significant changes outside of just sort of the deployment strategies that they are reconsidering. He was on the board for many years, so I think he's got a good handle on sort of the underlying puts and takes of the business.
Okay, and moving on now to BBWI, Bed Bath and Beyond, right?
No, close, but Bath and Body Works.
Bed Bath and Body Works.
That's a mistake that everybody makes.
So close.
And
I shop there regularly, as you can tell.
also a turnaround story. The men's business is doing okay for them. So maybe it's something you should check out. But I think they have a new CEO who came in from Nike last year as well, and they're making some changes to their business, refocusing on their core competencies, exiting lines that really aren't accretive to them, and really trying to figure out how they can be more productive. So still expanding in the off-mall channel, which tends to be a more productive store base, launching their Amazon store, which is something that they didn't have before, and really just trying to meet consumers where their needs are. And so I think there's a lot of opportunity for margin expansion in this business because I think the firm got a little bit distracted as to sort of what its best ROI opportunities were. And now it is sort of re-honing in on that, which should allow profitability to reaccelerate.
And is Amazon a place you feel this company could thrive?
Well, so, there were third-party sellers out there selling their products, right? And it was moving, but now they can control the messaging. And for people who are impatient and they want, to get everything in one place and not go to a store or not go to a separate website, I think it gives them an opportunity to just reach consumers at another touch point. So even if it's $100 million in revenues first year, it's another channel where they are penetrating and controlling the narrative.
Any concerns? I mean, if we see oil prices stay up where they are, put pressure on consumers, this might be one of the places where they cut back?
Well, I think this is actually affordable luxury. I think when we look at oil prices and what's happening in Iran, certainly the cruise lines are the companies that have been hit pretty heavily by this. So Norwegian may be something that's impacted. Consumers get worried about traveling towards the Mediterranean and whether that can spread. And so I'd be more concerned about Norwegian than I would be about Bath and Body Works.
All right. Well, wrap it up there. If they merge, though, Bed Bath and Body Works and Beyond, I think. I can see that name. It's a little long, but I think it works. Jamie, thanks very much for joining us today.
Thank you.
Jamie Katz, Senior Equity Analyst at Morningstar. And let's take a look at some of the notable analyst calls and recommendations. TD Cowen analyst Vince Valentini cutting the recommendation on Canadian telecommunications stocks, Rogers, BCE, and TELUS to hold from buy. You can see they are off today. BCE down by 2.86, Rogers by nearly 5%, and TELUS off by a little under 2% right now. And they've been dropped to a hold from buy, writing that recent strength has been due to investors seeking a safe haven during the war in Iran. In a note to clients, Valentini wrote, quote, "The data on key volume, population, and price drivers has been weak throughout the first quarter of 2026, but telco stocks have likely been supported by dividend yields and investors seeking safety from geopolitical uncertainties." BMO analyst Tim Casey struck a similarly cautious tone in a Wednesday note, cutting Q1 growth estimates for the three companies based on elevated competitive intensity in a low loading period. And of course, BCE is our parent company here at BNN Bloomberg. Yesterday on Market Call, we were joined by Michael Sprung, president of Sprung Investment Management. His focus, Canadian large cap stocks, and his top picks were Vermilion Energy, Bank of Nova Scotia, and ATCO. Today on the show, we have Richard Orrell, portfolio manager at RN Croft Financial Group. His focus, ETFs. And coming up, we'll hear how Stellantis could be a part of a plan to make Chinese EVs in Canada. Stellantis is discussing options for building electric vehicles in Canada with a Chinese partner, according to people familiar with the matter, a sign of how quickly the auto industry is being reshaped after Canada opened the door to companies from the world's largest car market. For more on this, we're joined now by Bloomberg Canada government reporter Brian Platt. Brian, thanks very much for joining us.
Thank you.
Give us some details on this. How would it unfold, or how might it unfold?
So we've known since the fall that Canada and Stellantis, the Canadian government and Stellantis, along with Unifor, the union that represents this plant, and other stakeholders, have been involved in negotiations over the future of this big assembly plant in Brampton. There was a plan to produce a Jeep Compass there, and that got canceled last fall and moved to the U.S. Basically, it was a result of Donald Trump's tariffs. And so when the plan to build the Jeep there got moved, the question was what was going to replace that production in the plant. The government was threatening legal action because Stellantis has received taxpayer subsidies. And what we understand is that one of the options Stellantis is talking to the Canadian government about is building an electric vehicle there, but with a Chinese electric vehicle. Stellantis has bought a stake in a company called Leap Motor in China. They are partnering in a few other countries around the world to build Chinese electric vehicles. And so that is one of the options now that Stellantis is talking to the Canadian government about.
Now, the Premier of Ontario has been quite vocal about how this might unfold, not entirely excited about it.
No, well, what we've heard after our story got published yesterday on this was an outcry from a few places, from Unifor, from Doug Ford, and from Flavio Volpe, who represents a lot of the Canadian auto parts manufacturers. what Stellantis wants to do is something called knockdown kits. And that's where the car parts are basically all built in China, shipped here in boxes, and then the car is just, the only thing that happens at the Canadian plant would be final assembly. And that is what Leapmotor and Stellantis are planning or have already done in some of their other locations around the world. And so that's what they are staunchly opposed to any plan to do that in Brampton. And really, it would be a political poison pill in so many ways for the Canadian government. This is the exact thing that everybody warned about in opening up the auto sector to China, was that you were going to carve out the auto sector, carve out our industrial capacity. We would lose our unionized jobs in these factories because you don't need nearly as many people when all you're doing is just bolting the car together and the parts are built overseas. So this is, I think, the core of the negotiation that's happening right now between Stellantis and its government and the union is, if you do build electric vehicles in this plant, how much of that car is going to be produced locally in Canada?
And what kind of a say would the federal government or the provincial government have in this happening?
Well, I mean, I think it's an interesting question because it's not. This is a little. We don't really have a strong precedent for this, really, probably at all in Canada. Around, you have this existing plant, and then the company has partnered with in this case, a Chinese company who may come in and use that plant to build a different type of car there. This is really an unusual situation. I'm not, so I don't know 100% what legal tools the government may have to block this. But of course, there's all kinds, if they wanted to block it, that is. But there's all kinds of political and financial tools that they could potentially use, right? So I think ultimately what Stellantis would want to achieve here with the government and with Unifor is to come to a negotiated agreement, assuming that they do proceed to build electric vehicles in this plant, a negotiated agreement over how that would happen. And I think that's what is being discussed right now behind closed doors.
All right. Imagine Stellantis would like to say, hey, look, we're honoring our deal with you. But and then, of course, the wild card, literally, Donald Trump, President of the United States. We've got CUSMA negotiations coming up. How will this be taken down south of the border, do you think?
I mean, it's a very interesting story in terms of the North American auto sector, because on one hand, this is a ripple effect of what happens when Donald Trump imposes tariffs on his North American partners, right, on Mexico and Canada. If it wasn't for those 25% tariffs, this Stellantis plant would probably be building Jeep as it was planning to do, a Jeep SUV. And instead now you have the prospect of a Chinese electric vehicle being produced there, which at least many people in Donald Trump's administration say they don't want. On the other hand, Donald Trump is traveling to China. I think that trip is now scheduled in May. And there's questions around whether he may, look at cutting some of his own deals with Chinese companies, car companies, when he makes that visit to Beijing. And so I think the question of how this plays out in Canada-U.S. trade negotiations is a huge one. And no doubt this is going to come up a lot once those negotiations actually formally begin, which could be any week now.
All right. And just quickly before we go, any time frame for this Stellantis deal at all?
No, but that plant is sitting idle. And so I think they don't have an infinite time frame here, but I don't think at this moment there's a hard deadline.
Okay. Brian, thank you very much for joining us. We appreciate it.
Thank you.
Bloomberg Canada's government reporter, Brian Platt. Now, before we go, let's take a quick peek at the markets and see how they're doing. The TSX up first. And you can see that it is, oh, look, it's now in the green. What a turn. After starting off down more than a point, it's now up above 33,000 and up by about a third of a point right now. MDA Space, one of the top movers today. Of course, it is involved with NASA, and CEO was down there watching the launch yesterday, but it supplies equipment to Globalstar, which Amazon is interested in buying for $9 billion US. So right now, MDA is up about 6% after seeing some drops. And taking a look at the TSX over the past week, what a week it's been, but it's going to be a green week, at least for now. The day is still young, though, so we'll have to see what happens. Quick look at the U.S. markets. and see how they are responding. Oh, they're clawing their way back after their overnights. The futures were looking really rough, but now you got one in the green and two barely in the red. That wraps up this edition of The Open. Morning markets are up next. Thanks very much for joining us. I'm Roger Peterson.